Hello everyone, welcome back. In this one, I'm going to be doing a market review and trade recap, going over the trades I took today. In this one, I will also be covering levels that I use every single day to frame high probability trade setups. Let's get into it. So looking at the daily chart here on E-mini S&P, we see we have this daily volume imbalance here as an inefficiency. If we're bullish, which I am, I covered my weekly outlook yesterday, and I still am bullish going into the rest of the week based off what I see right now. My session bias was actually bearish today. So I was looking for lower prices in the morning session, and I'll go into in the lower time frame what allowed me to pivot and be bearish in the morning session. But it's very important to remember with your daily bias or your weekly bias, whatever you're looking at as a higher time frame draw liquidity, that doesn't always guarantee that every single session is going to be straight up. So you also have to know how to read the market structure, read the order flow in the lower time frame so that you can be flexible. So looking at the daily chart here, we have that, again, daily volume imbalance. We traded higher into the previous day's high, which is this previous candlestick, that high right there. Market traded up into that and that daily volume imbalance, which is what I had as a target going into 9:30. Once we traded up into these premium levels, that then created the short setup that I was looking for today, back down into the range. We ended up closing where we opened indecisive day, which is to be expected again on a Monday with no news, and we have a lot of economic data coming this week. Indecisive day, really clean price runs intraday, but we do see it was indecisive at the close. Still am looking for higher prices though to the targets I shared in the weekly outlook yesterday. Working down into the hourly chart here, we see this is the 9 a.m. candle. So this is when I'm getting to my desk going into 9:30 to trade this morning session expansion. So we see at 9 o'clock, I want to look at where does the market trade to first? What liquidity does the market attack before the real move? And we see at 9:30, the market runs higher above the previous day's high. You're going to see as we go throughout the time frames, I have each high and low classified based off the time it forms. Time-based liquidity is what gives me setups every single trading day. So here we have the previous day's high, market traded up into it, and then we get a strong rejection, breaking back down into the range. This then gives me insight that the market's going to want to attack the opposing liquidity, which is these equal lows here and here. And then we see from the buy side, working down into the sell side liquidity. All right, 15-minute chart here. We can see at 9:30, let me go over the levels that I have here just to keep it simple. 9:30, that's the opening price. That's when I'm sitting at my desk. What I'm looking at 9:30 is these lows and highs that you see marked out on the 15-minute chart. So at 9:30, the buy side is what here? That's the previous day's high or previous week's high on Friday. And then from there, we have this low here, which is the opening range low. That's a low that forms the first 30 minutes of trading from 9:30 to 10 o'clock. These lows are very important. Also, here we have the pre-market lows, which forms after 7 o'clock. The pre-market session is from 7 to 9:30. Any highs and lows that form between that window are going to be very important for my morning session trading. So you have relatively equal lows there, pre-market. And then here we have the London low, because this low forms from 2 to 5 o'clock. And then back here, technically this low forms outside of London. It forms before 2 o'clock. However, because this is where the impulse run in London began, there's going to be a large influx of liquidity below this low as the market trades down below it. So these relatively equal lows there just have that labeled London low. What you want to start doing as a developing trader, someone that wants to do this consistently, wants to be able to make money month over month, you have to be doing this every single day. If you're not taking 45 minutes to an hour to look at your daily chart, your hourly, your 15, your 5, and work all the way down, you're going to take years to develop versus someone that just does it the right way. Right? This is the hard work it requires. And if you do this, trading is going to become so much easier because you're going to start looking at the market top down every single day, seeing what the market's doing on the daily, the hourly, all the way down to your 1 minute chart. And then you're going to see how the price runs begin top down. And then you're going to start having confidence to know what you're looking for because you've seen it before and you're getting the reps. Many people aren't going to tell you this. They're going to sell you easy dreams, easy entry models. But the truth of the matter is, unless you do this the right way and you focus on the right things, you're constantly going to be chasing new models, new educators, if you don't do the necessary work. And that's what this looks like. So 9:30, the market trades higher. That's the Judas swing, trading into the previous day's high. Last week, we've been going up all week. Overnight, we've been going up all night, and they left all these equal lows here intact. So at 9:30, they send it higher. That's a Judas swing or the fake run. I want to see what they do in close proximity to 9:30. 9:30, they take it higher first, and then we see what? An aggressive breakdown from here. That then allows me to anticipate that the draw is going to be these relatively equal lows here that formed before the 9:30 open. Then you can see the market trades higher, hits this up close candle, which is also a bearish order block, and then the market rotates to the downside. All right, 5-minute chart, keeping the same levels on here so you guys can reference these lows as it relates to time. We see again at 9:30, the market runs higher first, and then we get an aggressive breakdown here. This here is a shift in market structure after running buy stops. So this is the classic ICT 2022 model right here. Above the 9:30 opening price, we have a dealing range high, dealing range low, market trades up into a premium, and then we get a sharp breakdown into these relatively equal lows here. All right, working down into the 1 minute, have quite a few things on here, so let me go ahead and break it down for you guys. We can see we have a dealing range, high and low. The reason this high and this low is because this high here takes out buy stops, this low here takes out sell stops, then we retrace back into the range. What I also have here is the first presented fair value gap. You want to extend that through for the remainder of the day, and you're going to see how influential it is, especially when we look at time. So at 9:30, they run it higher first. That was the Judas. Then the market broke down. I ended up taking a short on NASDAQ here, and I'll show the trades in a minute, looking for a run to the downside, which ended up stopping me out. I took 3 trades total today. 1 full stop out, 1 break even, and 1 winning trade. It all came out into the wash to be about break even on the day though. Do keep in mind though, as a trader, the only acceptable outcomes are small losing days, small winning days, big winning days, but what's unacceptable is large losing days. So the boring days, the break even days, the small loss days are all part of the process. So we see the market breaks down here and then we retrade back up into the range here. Once we traded back to equilibrium or a premium market, and then we respected that first presented gap in here that you can see, and then we broke down through this gap, that was a shorting opportunity for me. So putting up the executions here, we can see the market displace lower. I'm not trying to short here. I don't want to chase the market lower. I want to let it come to me in a premium market, which is above equilibrium here. Once we trade above equilibrium and then we break down, I don't need the shift in market structure. I can see that this fair value gap was closed below here. The market tried to trade back up into it. Let me take off the label so you can see the candles. We closed below the inversion fair value gap and then we traded back up into it. The most effective way from my experience to use the inversion fair value gap is like this. Once we close below it, hit the low end. And if we can't even reach midpoint, as you'll see here, the market can't even reach midpoint. That signals it's extremely bearish. So as soon as it was leaving that range, I'm shorting inside this up close candle, expecting it to act as a bearish order block, looking for these targets here on the downside. The market ended up retracing deeply back into the range and then stopped me out at a little better than, or a little less than break even rather. So I ended up getting stopped out here on this deep retracement. Dylan, it was over 15 points of profit. Why didn't you take partials? Because when I'm in here trading, I'm looking to really take something from the market. I'm not looking for small runs. Depending on what the market's offering, I will take, 10 points, 15 points. But generally, if I'm going to sit down here for the morning session, I'm looking to take down this type of run right here. I'm looking for the bigger price swings. So being a bigger trader, naturally, it's going to happen to you where the market's going to retrace against your entire entry and get your stop at break even. That's fine. Wait for the next model to form. Market retraces, first presented gap. As soon as I saw the market pull back into the range and then it stopped me out at break even here on this trade, I could see the market was in a high resistance liquidity run. We can see that because we have a lot of overlapping price action. The market's staying in the range and banging around. What that then tells me to do is focus on macro window. So I immediately take my attention to 1050 and I want to see how we trade at that time. We already covered the drawn liquidity. Buy stops have been taken. We have all these time-based lows below us. And then I want to see what we do in the macro window. We trade up into that first presented gap here, extend that through. We stay in the lower half and then we break down. As soon as we respect this up close candle and treat it as a bearish order block, I go short here inside this candle as a bearish order block. The stop has to be between 3 levels. So if I'm shorting this up close candle here, I want my stop to be between this up close candle, this inversion fair value gap, and this up close here. So I entered here with the stop just above this high. So I was about 7 points of risk and I was aiming for around 17. So generally I'm looking to go anywhere from 2 to 1 on my risk to reward. Risk to reward isn't something I pay too much attention to. Like I will still take setups that are 1 to 1.5. Very rarely do I look for 1 to 1 setups, but generally I'm looking for 2 to 1, 3 to 1, 4 to 1. This one did offer 2 to 1 here, but it ended up retracing and stopping me out. So what I did here, since I just had one contract, I would have ideally liked to have taken a partial here, rolled the stop to break even, and then let that last contract run. But because I just had one contract, I had to manage it with a stop loss. So as the market traded below my first target here, I had 2 options. Go short here inside the order block, cover below this low here, or allow it to keep dropping and try to get these pre-market lows here. What I ended up doing was letting the market trade lower, as we started trading through these lows, I aggressively trailed the stop above the most recent candle. So once we broke down through this low here, stop trailed to this high. Once we created this candle here, I trailed the stop to that high there. The reason I'm happy with that trailed stop is because that's where I would have been getting out anyway below these lows. So I gave myself a free look for lower prices, but if it wanted to stop me out, I still locked in the gains from this price run here. The other trade that I took today on NASDAQ, just for completeness sake here, was this short right here. As we traded up, hit this first presented fair value gap in here. I thought it was going to be a quick scalp into these pre-market lows here. So I was just looking to go short inside this up close here and then look to take a price run below these equal lows. Took a very quick stop out though. Market took me out here and then I waited for what you saw here setting up in the ES. So I wanted to go short here. So as the market took out the buy stops and was breaking down, I had a limit order inside this fair value gap here, but the market just never traded up into it to give me a short to ride it lower. So I ended up having to wait. Wait for what? Dealing range, premium to discount. Wait for the market to trade up into equilibrium, and that's where the best setups are going to happen. And then I have what? The two most important things that I look for. Market retraces into a premium market and runs buy stops. That's going to give you a high probability trade setup every single day of the week, especially if you understand the draw on liquidity with what I'm sharing here. This is absolute money. Hope this one was insightful. See you guys in the next one.